Welcome to Class 3. In this class, we will learn about credit scores, what they are, why they matter, and what you can do to achieve or maintain high credit scores. In the latter half of class, we will turn our attention to federal income taxes. You will come to better understand how your tax bill is determined and acquire information that will be helpful in managing other parts of your financial plan. Take a moment to read over the learning goals for Class 3. Remember that the end-of-program assessment will be composed of items directly connected to these learning objectives. On the previous slide, I asked you to explain the usefulness of customer reviews. I expect you wrote that reviews help you know if you can trust the seller. They help you know what you can expect in terms of product features and quality. Reviews help you make a decision about whether or not to buy a product. A credit score is similar to a customer review about you, however imperfect, in relation to credit use. It helps lenders and other service providers decide if and how they might want to do business with you. A credit score is a 3-digit number between 300 and 850 that communicates information about your past credit behaviors. A higher number is better, as it is interpreted to mean that you are more likely to repay borrowed money in a timely fashion. You might be wondering where your credit score comes from. When you establish a financial relationship with a lender or other service provider like a property management company, they often report information about your financial actions to one or more of the major credit bureaus, Experian, TransUnion, or Equifax. The credit bureaus each compile that information in a home. Typically, when we say credit score, we are referring to a FICO score. FICO is the Fair Isaac Corporation, which dominates the credit score industry. FICO is the organization that takes the information from your credit report and plugs it into a proprietary algorithm to generate your credit score. Because each credit bureau has slightly different information about you, when the algorithm is applied to each report, it generates a different score. So you have multiple credit scores, but they are typically very similar. You will recall that one principle from the Magnificent Seven is be strategic. You don't see your credit scores that often, but if you are behaving in a financially strategic way, you will be sure to keep it in mind. Credit scores matter for several reasons. The first reason, with which most people are familiar, is that credit scores affect the interest rate you will pay when you borrow money. If you take out a loan to purchase a home or a used car, as in the example on this slide, the lender will look at your credit score to determine if you are a relatively low-risk or high-risk borrower. A high credit score indicates that you pose a lower risk as a debtor, you are likely to pay off the loan on time, and qualifies you for the lowest interest rate available. A lower interest rate can save you a lot of money over the life of the loan, in the case of this example, over $5,000. And those dollars could be invested or allocated to some other part of your budget. Given that interest rates are quite high right now, it's more important than ever to be sure your credit score qualifies you for the lowest possible interest rate. Sometimes we have third-decade participants who tell us, I don't really care about my credit score because I don't ever want to be in debt and so don't plan to borrow any money. That outlook is a bit short-sighted because your credit score shapes your financial life in areas beyond borrowing. For example, property managers might review your credit score when deciding whether or not to take you on as a renter. Better credit scores can help you access lower insurance premiums too. If you ever want to work for a financial institution or insurance company or a law enforcement agency, among others, a credit check is often part of the application process. For all of these reasons, we want you to be aware of your credit score and to know what steps you can take to increase your score. While the precise method by which the information in your credit report is translated into a numerical credit score is not publicly available, FICO does share information about the relative weight of factors that do influence your score. You can see here that the most important factor is payment history, that is, making on-time payments and avoiding collections, foreclosure, or bankruptcy. The second most important factor is amounts owed. That's a measure of your credit utilization, the percentage of your available credit that you are using. So, for example, if the only credit available to you is a credit card with a $10,000 limit, and you are carrying a balance of $1,000 on that card, then your credit utilization is 10%. The typical recommendation for achieving and maintaining a high credit score is to keep your credit utilization below 30%. You can see 3 additional credit score factors identified in the graphic on this slide. The longer the average age of your credit accounts, the higher your score. New credit matters. If you apply for a new loan or credit card, your score will take a small hit. The credit bureaus do allow for rate shopping, so if you plan to take out a new auto loan and are shopping around for the best deal, you want to confine those applications to a short period of time, as short as 2 weeks if possible, so it's clear that you are rate shopping rather than trying to take out multiple new loans. Finally, your score will be better if you can demonstrate that you are able to manage different kinds of credit, like a student loan and a credit card. One of the most common misconceptions related to credit scores is that carrying a balance on a credit card improves your credit score. It doesn't. The only thing your unpaid balance leads to is interest charges. The best course of action is to pay your credit card balance in full each month. Another source of credit score confusion stems from the impact of closing a credit account. If reducing your debt is one of your goals, it can feel incredible to close an old credit account after you pay it off. But you should be aware that if the account you close is one of your oldest accounts, your credit score will take a temporary hit when you do that because you may be shortening your credit history. Even if the account is more recent, your score will dip because when you close a credit account, you increase your credit utilization. By closing the account, you've reduced the amount of credit available to you, so any credit balances you do have will now be a larger percentage of your available credit. This doesn't mean you shouldn't close credit accounts. It just means you want to be strategic about when you do it. You wouldn't want to close that account just before you go to buy a vehicle or a home. Finally, choosing credit on a PIN pad device when you're using your debit card won't help or hurt your credit score because your activity with a debit card is typically not reported to the credit bureaus. This graphic highlights several of the actions you can take to improve your credit score. Payment history is the most important factor in shaping your credit score, so setting up automatic bill pay can reduce the risk of a late payment that could negatively affect your score. Reducing your overall debt can decrease your credit utilization and boost your score. Consider keeping old accounts open, especially if you are expecting to take out a loan in the very near future. This will ensure your credit score benefits from the length of your credit history. Finally, checking your credit reports regularly can protect your credit score from errors in your credit history. More details on how to do this are coming up next. Note, you do not need a perfect score to access the very best interest rates. Anything close to 800 will save you significant sums of money when you borrow for a home or a vehicle. The Fair Credit Reporting Act guarantees all consumers access to their credit report from each of the 3 major credit bureaus. During the pandemic, the major credit bureaus began allowing consumers to access their credit reports every week at no cost, and that policy is now permanent. The only place to access your free credit reports through this program is at www.annualcreditreport.com. There are a number of imposter sites, so you want to be sure to use the correct URL. Once you go to this site, the first step will be to prove your identity. You'll be asked a series of questions about past addresses or past financial transactions to establish that you are who you claim to be. Once you've established your identity, you will be able to choose which report or reports you would like to access. If you've never done this, or if it has been more than a year since you last checked your credit reports, we strongly recommend you visit this site and request at least one of your credit reports as soon as you can. It's possible that your credit report contains errors that may be negatively impacting your credit score. If you find incorrect information or evidence of identity theft, there is a process outlined in each report for making corrections. On the next slide, you'll be linked to a video that explains what you will see when you access one of your credit reports. One important note, your credit report will not include your numerical credit score, even though the video implies otherwise. In a moment, we'll provide information about how to access your credit score.
You know your credit report, that thing lenders look at when you apply for a loan, is important. But what is it exactly? Let's focus on the 3 main U.S. credit bureaus. They collect credit information from your bank, credit unions, credit card issuers, retailers, mortgage lenders, collection agencies, and public court records. All of the information about you from all sources is compiled into a credit report, an electronic file based on your previous and current credit history. Lenders can then access these credit reports to get a better understanding of whether you're a qualified or risky candidate for credit. Credit reports are dynamic. They change when lenders update your information or when new public records about you are posted. These changes can impact your FICO scores. Now, let's look at exactly what the credit report contains. Start with your personal identity information: name, address, and social security number. This information doesn't impact your credit score. However, you can protect against potential identity theft by checking for accuracy. Your reports also contain public records the court collects on bankruptcy. If you've ever had an unpaid bill turned over to a collection agency, that will likely show up on your report too. Information called trade lines form the heart of the report. That's information about your various credit accounts, such as when they were opened, the loan amount, and your current balance and payment history. Creditors typically report this information on a monthly basis. Finally, whenever someone accesses your credit file, an inquiry is reported. There are many types of inquiries, but the FICO scores only consider inquiries resulting from a credit application. All of this information forms the foundation of your FICO scores, a measure of your credit risk used by 90% of the top lenders. Now, FICO isn't a credit bureau, but rather a company founded on scoring credit reports. Working closely with the credit bureaus, FICO creates scores based on the bureau's data. Scores that make it easier for lenders to understand credit reports and determine your credit worthiness. And remember, you can and should review your own credit reports. Monitor them, check them for accuracy, and see what factors are impacting your FICO scores.
All consumers should review their credit reports regularly to check for errors, but probably you also want to know your actual credit score with at least one of the 3 credit bureaus. You have several options for accessing your score. First, there are several online credit score estimators. Our financial mentors find these to be highly accurate. At creditkarma.com, for example, you can create a free account and get an approximation of your credit score. Another feature of Credit Karma you might find helpful is the monthly email they send to account holders. These messages alert users to changes in their credit scores or simply nudge them to keep credit score in mind. Some financial institutions offer their clients information on their credit score as a perk, so you might check to see if a bank, credit union, or credit card company with which you already have a relationship provides this service. Finally, you can pay a fee to FICO or to any one of the 3 credit bureaus to get your current credit score. This graphic from the U.S. Federal Trade Commission highlights the difference between a fraud alert and a credit freeze, 2 fee-free steps you can take to protect your credit score from poor data security and the threat of identity theft. A fraud alert is less severe than a credit freeze and is available to those who believe they have been a victim of identity theft. Contacting just one of the credit bureaus to ask for a fraud alert is enough to apply it to your identity at all of the other credit bureaus. A fraud alert requires lenders to take extra steps to confirm the identity of anyone seeking credit with your name and identifying information. Of course, this means a minor inconvenience when you apply for credit, but one that may well be worth the extra bit of time. A more serious step is to freeze your credit. This essentially locks down your credit. You or anyone claiming to be you will not be able to get a loan or open a credit account until you unfreeze your credit. Here you need to contact all 3 credit bureaus to apply the freeze. If you would like to be extra cautious, you can implement a credit freeze and then lift it just before you apply for a mortgage or auto loan, and then once that new line of credit is established, refreeze your credit. So again, a fraud alert and a credit freeze are 2 free options available to protect yourself against the potentially negative credit consequences of poor data security. Whether you received a refund or had to send the IRS money when you last filed your income taxes, this portion of class will help you understand why and how that happened. I will walk you through a 5-step process for determining your federal income tax bill for a given year. I expect most of you use tax preparation software to file your taxes. This portion of class is going to help you see what is happening behind the scenes during that process so that you are better able to make financial decisions related to income taxes. The first step is to determine your adjusted gross income, or AGI. This is done by taking your gross income, the total of all income you earned during the year, and subtracting at any relevant tax deductions for which you qualify. If you don't qualify for any above-the-line deductions, then your gross income and your adjusted gross income are the same amount. Your gross income is the sum of the wages, salaries, and/or tips you may have earned as an employee, plus any income you might have earned as a freelancer, independent contractor, or gig worker. By the end of January each year, you should receive a W-2 form from any firm where you worked as an employee. If any firm paid you $600 or more for work as a non-employee, they are required to send you a 1099 form indicating the amount you earned. When you earn income as a non-employee, you need to remember that even though taxes were not withheld from this income, it is still subject to taxes. You will owe the self-employment tax of 15.3%, which is the sum of the employee and employer Social Security and Medicare taxes. The employer portion of the self-employment tax is tax deductible, however. You likely also owe federal and possibly state income tax on these earnings as well. For these reasons, you should consider setting aside some of this income for tax purposes. The most common recommendations hover around 30%. You can make estimated quarterly tax payments online or through the IRS's app, or you can request additional income taxes withheld from your pay with a traditional employer. I'll tell you more about that in the latter part of this class. A tax deduction is a dollar amount that can be subtracted from your income for tax purposes. Because a deduction reduces the amount of your income subject to income taxes, it indirectly reduces your tax bill. One group of deductions are referred to as above the line because of where they were once located in the tax document called Form 1040. This slide shows the most common above the line deductions. If you qualify for one or more of these deductions, the relevant amounts would be subtracted from your gross income. Contributions to a traditional workplace 401k or 403b are also above-the-line deductions, but those will already be reflected on your W-2 form. The next step is to calculate your taxable income by subtracting additional deductions from your adjusted gross income. Whereas only some taxpayers will qualify for above-the-line deductions, all will take a below-the-line deduction. You will either subtract the standard deduction or a sum of itemized deductions from your adjusted gross income to find your taxable income. Taxpayers will subtract whichever amount is larger. This deduction represents income that is not taxed at all. The table on this slide shows the standard deduction amounts for 2024 and 2025 so that you can see these figures are adjusted each year to account for inflation. You may be wondering about the head of household row at the bottom of the table. To qualify as head of household, you must be considered unmarried and pay more than half of the expenses of maintaining a household for a qualifying dependent. Here is a list of common expenses that can be added together for an itemized deduction. If a taxpayer qualifies for these and the sum of these deductions is larger than the standard deduction, they will take an itemized deduction. The deductions related to owning a home will come up later in a future class. As you'll see on the next slide, the vast majority of taxpayers take the standard deduction. Those who itemize deductions are disproportionately high income earners. Take a moment to review the itemized deductions before moving on to the next slide. Now your taxable income will be applied to the tax brackets, a commonly misunderstood part of the tax code. On the next slide, you will watch a short video about tax brackets. Note that the video will show 2023 tax brackets. Later in this class, we'll show you the current tax brackets. While the dollar amounts are different, the way they function remains unchanged.
Pop quiz. Do you know what tax bracket you're in? If you answered "it depends," well, you're right, because parts of your income are probably taxed at different rates. Say you have $50,000 in taxable income. Today, that dollar amount lands within the 22% bracket. But that doesn't mean you pay that rate on the full $50,000. Let's explain. In the US, your federal income tax is calculated through a progressive, graduated rate system. Basically, if you make more, you're taxed more. Right now, we have 7 tax brackets. Each bracket covers a range of taxable income, and the rate for each bracket gets progressively higher. Any income within the range of the first bracket is taxed at that rate. The next dollar you earn over the first bracket falls into the second bracket, and only those additional dollars within that range are taxed at the new rate. This continues as your taxable income increases. So in our $50,000 example, this much gets taxed at 10%, only this much gets taxed at 12%, and only this much gets taxed at 22%. As you can see, whatever your top tax rate is, it doesn't apply to all of your taxable income, just the portion that falls into your highest bracket. When we understand how brackets work, we can better understand the tax impact of picking up a second job, putting in overtime, or any other ways we might increase our income.
As you heard in the video, the U.S. has a progressive income tax code. This means that as a person's income rises, each additional chunk of income will be taxed at a higher rate. Those chunks are the tax brackets shown here. Note that these figures, just like the standard deduction amounts, are adjusted for inflation each year. It is possible that your bill may be further reduced if you qualify for any tax credits. Credits are much more powerful than deductions. Tax deductions lower your bill indirectly by reducing your taxable income. But tax credits reduce your tax bill directly by being subtracted from the amount of taxes you owe. Whether or not you qualify for any tax credits depends on your adjusted gross income, filing status, and other criteria. We've listed here common circumstances in which a taxpayer may qualify for a credit. Tax credit for green purchases include things like electric cars, installing solar panels, or making energy efficiency improvements to your home, and more. On the left, I have described a hypothetical taxpayer and shown how the first 4 steps of the process would apply to their circumstances. Contributions to a traditional individual retirement account, or IRA, are an above-the-line deduction, so that $3,000 is subtracted from her gross income. She won't owe taxes on that $3,000 in 2025, but funds pulled from that IRA in retirement will be subject to income taxes at that date. I assume the sample taxpayer took the standard deduction and did not qualify for any tax credits, so she paid a tax rate of 0% on the $3,000 she put in her IRA and on the amount of the standard deduction. Of her taxable income, she paid 10% on the first nearly $12,000 and 12% on the rest. Now we get to the question you most want to answer when you file your taxes. Will you get a refund or do you owe additional dollars to the IRS? If, like most people, you work as an employee, you pay taxes all throughout the year as federal and, if applicable, state income taxes are withheld from your paycheck by your employer. When you file your taxes each year with the Internal Revenue Service, what you are effectively doing is settling your account with the IRS. If you overpaid during the year, you'll get a refund for the difference between what you owed and what you paid. If you underpaid during the year, you'll have to make up the difference with an additional payment to the IRS. Ideally, your withholding over the course of the year comes close to matching your actual tax liability, so your refund or what you owe is very small. Getting a big refund can be exciting, but that means you gave the government an interest-free loan over the year. If you were to reduce your tax withholding, you could have had a slightly bigger paycheck all year and possibly earned interest or other returns on a portion of that money by putting it in a high-yield savings account or your retirement account. You can adjust your tax withholding with your employer by making changes to Form W-4, a document you filled out in the onboarding process at your job. There are 5 parts to Form W-4. Take a moment to make note of which parts apply to your situation. The IRS has made an online estimator tool available to help taxpayers fill out this form, and your human resources representative may be able to provide additional guidance. In Part 4, you can tell your employer about independent contractor income you earn and have that reflected in your withholding. If you don't want your employer to know you have 1 or more side jobs, you can simply request they withhold an additional specific dollar amount for taxes in Part 4 on Form W-4. You might be wondering why we spent so much time digging into the federal income tax system when most people use tax preparation software that makes it possible to file your taxes without understanding the process. We think it's important for you to have this information because other financial decisions, particularly those around housing and saving for retirement, are tied to your tax circumstances. Additionally, you can use this knowledge to better evaluate proposed changes to the tax code, and you can impress others at social gatherings. This class is most connected to maximize value and be strategic. Keeping your credit score front of mind can help you reduce costs and maximize your value when you borrow money and seek a variety of other services. Understanding the federal income tax system can help you be strategic in other parts of your financial plan. We'll be providing more details about that in future classes. You will recall that these are the learning objectives we set out with. Take a moment to reflect on them. How confident do you feel about your ability to do all the things listed on this slide?